30 minutes, one military operation, one president captured, January 3rd, 2026. Maduro is gone. Venezuela is under American control. And if you own Chevron stock or any energy ETF, you need to understand exactly what this means for your money. Today, we break down what every investor needs to know after America captured the president of Venezuela. Oil prices, energy stocks, emerging markets, safe havens, everything you need to make smart decisions with your portfolio. Quick note, this info comes from multiple sources. If something is wrong, drop a comment. We make economics so simple that anyone with zero knowledge can understand. Let me give you the situation first. Saturday morning, January 3rd, markets are closed. You wake up, check your phone. America just bombed Venezuela and captured President Maduro. He is now in a New York jail cell. Your first thought as an investor: what happens Monday morning when markets open? Oil futures are not trading. Stock exchanges are closed. You have 48 hours to figure out your next move. This video will help you do exactly that. Let me break down 5 things every investor needs to understand right now. First, oil prices, why they did not spike. This surprised a lot of people. You would expect capturing the president of a country with the largest oil reserves on Earth to send crude prices through the roof. It did not happen. When markets opened, oil barely moved. Brent crude stayed around $60 per barrel. West Texas Intermediate around $57, almost no reaction. Why? 3 reasons. Reason 1, Venezuela barely matters to global supply anymore. They produce about 900,000 barrels per day. That sounds like a lot, but it is less than 1% of global production. The world pumps over 100 million barrels daily. Venezuela is a rounding error. Reason 2, the market was already oversupplied. OPEC Plus has been struggling to keep prices up for months. There is plenty of oil available from Saudi Arabia, from Russia, from American shale producers. Losing Venezuelan barrels changes nothing in the short term. Reason 3, this is the important one. Traders are looking ahead. If America stabilizes Venezuela and foreign investment returns, production could explode. We are talking 2 to 3 million barrels per day within a few years. That is a lot of new supply hitting the market. More supply means lower prices. So the market is actually pricing in a bearish long-term scenario. Prices could fall further if Venezuelan production recovers. What does this mean for you? If you were hoping oil prices would spike so you could profit from long positions you missed the trade, the smart money already priced this in. If anything, look for prices to drift lower over the next 12 to 24 months as Venezuelan production comes back online. One more thing about oil. The type of crude Venezuela produces is heavy sour. This is different from American light sweet crude. Heavy crude is used for diesel and industrial products. American refineries on the Gulf Coast are specifically designed to process this type of oil. So, Venezuelan crude flowing to Texas refineries makes economic sense. It is not just about politics, it is about chemistry. Second, energy stocks, who wins, who loses? This is where it gets interesting for stock pickers. Chevron is the obvious winner. They are the only major American oil company still operating in Venezuela. They never fully left. They have boots on the ground. They have relationships. They have infrastructure. Right now, Chevron produces about 150,000 barrels per day in Venezuela under a special license. If sanctions lift completely and investment flows in, they could ramp up significantly. We are talking multiples of current production. Chevron also has first mover advantage. When other companies are still negotiating contracts, Chevron will already be pumping oil. That head start is worth billions. Trump specifically mentioned Chevron in his announcement. He said American oil companies will invest billions to rebuild Venezuelan infrastructure. That is basically a green light for Chevron to expand aggressively. If you own Chevron stock or are considering buying, watch the news carefully. Any announcement about expanded operations in Venezuela will move the stock. ExxonMobil is more complicated. They got kicked out of Venezuela in 2006 when Chavez nationalized foreign oil assets. International courts awarded Exxon billions in compensation. Venezuela never paid. Would Exxon go back? Probably. If there is a stable government that honors contracts and protects foreign investment, that is a big if. But if it happens, Exxon has the capital and expertise to become a major player again. Other potential winners include Halliburton and Schlumberger. These are oil services companies. They provide drilling equipment, technical expertise, maintenance services. If Venezuela opens up for business, they will get contracts. Now for the losers. Russian energy companies like Rosneft had joint ventures in Venezuela. Those contracts are now worthless without a friendly government. If you have any exposure to Russian energy stocks, this is bad news. Chinese state oil companies like CNPC also had operations in Venezuela. Same problem. American-controlled Venezuela will not be friendly to Chinese investment. Expect those contracts to be renegotiated or canceled. Third, emerging market exposure. Check your funds. This one catches a lot of investors off guard. You might own Venezuelan assets without even knowing it. Many emerging market bond funds held Venezuelan debt. The country has been in default for years, but some funds still carry these bonds at distressed prices, hoping for recovery. What happens to that debt now? Nobody knows. Will a new American-backed government honor old obligations? Will they restructure? Will they default completely? These questions will take months or years to resolve. If you own emerging market bond funds, check the holdings. Look for Venezuela exposure. It might be small, but it could create volatility. Emerging market equity funds are less affected since Venezuelan stocks were already removed from most indices years ago. But there could be second-order effects. Other Latin American markets might see outflows as investors reassess regional risk. Countries like Colombia and Brazil could see currency pressure, not because their economies are weak, but because investors get nervous about the whole region when something dramatic happens nearby. If you have significant emerging market exposure, consider whether you are comfortable with the increased uncertainty. This might be a good time to rebalance toward developed markets. Fourth, safe haven assets, flight to quality. When dramatic geopolitical events happen, investors typically flee to safe assets: gold, US Treasury bonds, the US dollar, Japanese yen, Swiss franc. Did that happen here? Somewhat, but not dramatically. Gold ticked up slightly. Treasury yields fell a bit as bond prices rose. The dollar strengthened marginally against emerging market currencies, but nothing extreme. Why the muted reaction? Because markets do not see this as a major crisis. Venezuela was already a basket case. Maduro was already isolated. The change in leadership does not fundamentally alter global economic conditions. Compare this to events that really moved safe haven assets: the 2008 financial crisis, the COVID pandemic, the Russia-Ukraine war. Those were systemic shocks. Venezuela is more like a regional adjustment. That said, if you are nervous about global instability, this might be a good time to review your safe haven allocation. Having some gold or treasury exposure is never a bad idea when geopolitical tensions are elevated. Do not panic buy though. The time to build safe haven positions is before crises happen, not during them. If you do not already have exposure, consider adding some gradually over the next few months. Fifth, long-term opportunities. Where is the real money? Here is where sophisticated investors should pay attention. The real opportunity is not in trading the news, it is in positioning for what comes next. If America successfully stabilizes Venezuela and opens it to foreign investment, we are looking at one of the biggest oil infrastructure projects in decades. 303 billion barrels of reserves, crumbling infrastructure that needs complete rebuilding, tens of billions of dollars in investment required. Who benefits from that? Oil majors like Chevron and Exxon, obviously, but also engineering firms, construction companies, pipeline operators, refinery specialists, the entire oil services ecosystem. Think about what happened in Iraq after 2003. Despite all the chaos, American companies made billions rebuilding oil infrastructure. Venezuela could be similar, but potentially more profitable because the country is more stable and closer to American markets. The Houston oil services industry is probably already preparing proposals. If you want exposure to this theme, look at companies headquartered in Texas with Latin American experience. There are also opportunities in Venezuelan debt. Right now, it trades at pennies on the dollar. If a new government honors some obligations, those bonds could multiply in value. This is high risk, high reward territory, only for investors who can afford to lose everything. Finally, consider currency plays. If Venezuela stabilizes, their currency could strengthen dramatically from current levels. But this is extremely speculative. The bolivar has been worthless for years. It would take a miracle for it to recover meaningfully. So what should you do Monday morning? Let me give you a simple framework. If you are a long-term investor, do nothing dramatic. This event does not change the fundamental case for diversified portfolios. Stay the course. Maybe add some Chevron if you like the Venezuela thesis. If you are an active trader, look for overreactions. Markets often overshoot on news events. If energy stocks spike on Monday, they might pull back Tuesday. If they drop, they might recover. Trade the volatility, not the news. If you are risk averse, review your emerging market exposure. Make sure you understand what you own. Consider trimming positions in funds with Venezuela or Latin American concentration. If you are aggressive and have money, you can afford to lose. Look at distressed Venezuelan debt or options on oil services companies. High risk, high reward. Most importantly, do not let headlines drive your decisions. The financial media will be full of dramatic stories about Venezuela for weeks. Most of it will be noise. Focus on fundamentals. Focus on your investment timeline. Focus on your risk tolerance. January 3rd, 2026 changed the political map, but it does not have to change your investment strategy. Stay calm, stay informed, stay disciplined. The investors who make money from events like this are not the ones who panic. They are the ones who think clearly while everyone else is emotional. Be that investor. Do not forget to subscribe so you do not miss any videos.